Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Welcome back to the show.
Hello, Jim.
The U.S. election, what kind of result is that going to have on economic action, not just here in North America, but around the planet?
Well, I don't know that it has a direct impact. I think, if any, it may, the more balanced power in the Congress, giving Democrats back more seats in the House, basically makes it less likely, perhaps, that there'll be further tax cuts, for example. And although that is a good thing, because the debt has been really swelling with the tax cuts that have been implemented already, it also suggests that there could be less government spending, stimulus, deficit spending, that kind of thing. And that may be relevant because the global economy had already entered a downturn long before the midterm elections this week. And we've seen that across the board in everything from, copper prices and most commodities. The price of oil is down 20% just in the last month. Copper prices are down 17% since the summer. Emerging markets have been tanking all around the world. Some 93% of international markets are now below their 200-day and 50-day moving averages. So these are leading indicators of the economic cycle. Typically, the stock market is a good leading indicator of the economic cycle, and it has been falling. So the U.S. was really an island unto itself in terms of having strength in its stock market in the past little bit, and we've seen U.S. confidence numbers, which are also a leading indicator, top with the stock market, and unemployment, of course, being at an all-time low. So those things, that was all happening long before the midterm elections, and I think, if anything, it's likely to be perhaps accentuate the downturn that has already started, because, as I say, there'll be less potential for this deficit spending, and that really has been one of the strong suits or the supportive aspects in the U.S. GDP figures. If you look at the fiscal boost that's come to GDP growth from the U.S. government spending just in the last year, it's been significant. As we've seen, underinvestment in the business sector, and we've seen households start to pull in now. We're seeing weakness in U.S. home prices. The interest rate rises that have happened to date have already increased the monthly payment amount to buy a new house in America is up 16% just year to date. Car payments are up 15% over the past few years. So the rate hikes that were started have already been biting into the consumer sector, household spending, and certainly into the housing sector, which has typically been a pretty significant part of the economic engine in the United States, certainly biting into car sales. So those things are already sputtering, and now we have this potential for less government stimulus, which has been one of the bright spots in terms of spending in the last year. So I think all of that together sort of add to this outlook of slower growth as we head into 2019.
We'll have more with Danielle Park right after this.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
Welcome back. We're speaking with Danielle Park. Danielle, with stock markets, it seems, on their way down, is it going to be hard for people to retain their wealth for retirement?
Well, in a nutshell, yes. The difficulty is that, we've essentially had a Ponzi-like financial environment now over the last decade since the Great Recession. We saw, a Ponzi-like environment in the United States into the peak in 2007. And then we saw the negative impact when all that froth and speculation and leverage and debt on debt imploded. Then people's balance sheets, which again, we talk about, the things that are coincident with high stock markets is things like consumer confidence, record low unemployment, and also balance sheets are about as good as they get when you've got a top in stocks and real estate. And that's really what the case was over the past year. And so now we've got all this massively correlated, positively correlated things like income from business and employment tends to peak with the stock market, with home prices, so that when things reverse, people are really hit across the board. Not only does their income drop, their employment perhaps drop, their business income drop, but they also see their savings tank. And this time, because it's been contagious even to housing at the same time in Canada and the United States, we're starting to see weakness in home prices at the same time. So that really whacks people because, what I like to say is you want to have your savings on a negative correlation to your income if possible. So that means that, if you're doing great in your job, you should be packing away your savings, but not necessarily piling into cyclical risk assets like the stock market, right? The time to be piling into cyclical risk assets is after they've tanked, after they've come down in the cyclical downturn, come off in price a great deal and everyone's scampering for cash. That's the best time for you to then move some of your savings into these cyclical assets. But because people tend to do it the opposite, they tend to put more in as prices peak, as their optimism grows, just as they're about to have these very destabilizing events across the board in their financial picture, they are always sort of victimized by this cycle. So it's definitely a big risk because for the last 20 years, let's say, people have dramatically undersaved relative to the hopes and dreams they have for retirement, for the length of retirement, and for the level of income they would like to have to spend during the retirement years. And the sad part about that was it was both their fault for being unrealistic and underestimating and not having the discipline to save as much as they should have, taking on lots of payments for things like cars, changing cars frequently rather than just paying them off and driving them for years, that kind of thing. So people didn't save enough, and then the financial sector encouraged people that they didn't need to save more. What they needed to do was buy more flashy, risky products, right? They were sort of doing this deal with the devil that said, I know you're not saving much, but we'll make up your deficit. This is what the mantra was across the board. This is what they've told us in, pension plans, in public and private pension plans, whether they're government or else, otherwise. And of course, like I was saying about confidence going up with asset values, it looks great when the cycle is, frothy and prices are high, but then when it mean reverts, the water recedes and all of a sudden you see these big holes in the savings pots, and that's where we're heading again. And of course, this cycle, sadly, people are a decade older than the last cycle. So you've now got this position where more people are, either at retirement now or planning to retire in the next few years, and they'll be looking to their pot of savings to fund that retirement, just at the same time that their pension plans may surprise them with, either deficits or not paying out what they'd promised. And at the same time that their assets on their balance sheet, which they currently have in these risky assets, could go down significantly in the next little while. So it's all very unfortunate timing for an aging population. And as I say, Ponzi schemes always look great before they're revealed to be what they actually are, which is a mirage. And I think that that's what a lot of people are going to experience over the next while as these prices mean revert and come back down to historical norms.
We'll have more with Danielle Park right after this.
Grand Portage Resources recently completed the 2018 drill program on its 100% controlled Herbert Gold discovery property located in the prolific Juneau Belt in southeast Alaska. Drill results are expected through late 2018. Past drill results included numerous multi-ounce gold assays on multiple veins. Grand Portage trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, are people who've been using their home equity as an ATM, are they the ones who really are going to run into a lot of trouble?
Well, yes. It's classic behavior, and we saw that in the U.S. cycle into 2006-07. And, if you do, I put a graphic on my blog this week comparing the Canadian average, home price, average income, average ratio of price to income relative to the U.S. And today, Canada, of course, is much worse. For example, we need 56% more money today to buy a home in Canada, the average home, than we did 10 years ago. Unfortunately, our income's only gone up 15%. The average income has only gone up 15% in the last decade, whereas housing prices have gone up more than 3 times that. So that's a big problem. Rents as well are up 25%. That's dramatically more. Home prices in the U.S. rebounded in the past decade after their big collapse, but they're just up about half as much as Canadian prices. So that's a big problem. Our affordability ratios, when you look at, the ratio of medium home sale price divided by the median annual income. In Canada today, it is 6.7, which is on the affordability scale right off the chart, literally. The top end of an affordability scale of 5.1 and over is considered severely unaffordable. And that's, Canada, as I say, is 6.7. We were just under severely unaffordable in 2008, and we've got much worse since. Whereas in the U.S., the housing ratio was 4.7 in 2008. It's 4.9 today. So we're still seriously unaffordable in the U.S., but nowhere near as bad as we are in Canada. So using ATMs has been, the answer to the deficit, the difference, people's income not keeping up with their cost of living increase, particularly when it comes to housing. And what they've done is just refied the house, as the notional value has increased. But as the price flattens and begins to come down, and we're definitely seeing that now in Ontario, many markets are quite soft. Certainly in the area where I live, north of Toronto. I just had coffee this morning with a realtor friend who was saying, the market's definitely changed over the last year, and many sellers are still expecting that they should get what they heard, a neighbor got a year ago, and we're in a dramatically different market. And not just sales now. We've talked for the last year about how sales volumes were falling, Jim, but now it's actual price that's falling as well. And so that is likely to continue. So at the same time, we have the banks getting much more cautious and concerned. They should have been cautious and concerned when prices were leaping at, leaps and bounds above normal increases and people were becoming so levered. Now that people are so levered and prices are falling, banks are becoming much more risk-averse, concerned about pricing. When someone brings in a deal where they agreed to pay X, the bank will say, well, we're not going to loan you what we said we would loan you because we don't think it's worth X. We think it's worth less. And people are having to come up with the balance. And, of course, most people have already overstretched just to get that house. They don't have an extra pot of money sitting around. There's also rumored changes coming with respect to HELCOs. There was news yesterday that, home equity lines of credit, that some people have them, not with a balance of zero. So it's a line of credit they could spend, but say they're sitting there with it at zero. If they go to apply for another mortgage to make another property purchase, whether it's a rental or a vacation property or something of that nature, the bank will start assuming that their line of credit is maxed out and factoring that notional payment in to decide whether or not they are within the total debt service ratios. So this is another tightening thing because people who have lines of credit and have been used to seeing that as savings, as a place to fall back to for whatever need or deficit they may have on a monthly or yearly basis, are now going to have a harder time borrowing for anything else as so long as they have this line of credit. So it's all these nibbling at the edges, the various foreign tax changes, the rate increases which have been significant. All of that has really impacted North America in particular in terms of our spending ability, but the whole world as well is, like I say, in the same sort of shock, let's say, from the rising rate cycle that's been going on now over the past couple of years.
I've heard, too, Seattle did have a big real estate boom with Chinese money coming in, but with the Chinese government now seriously cracking down on how much money they can take out of the country, even Seattle seeing a downturn in foreign sales. Did people expect that the Chinese would just keep marching in with more buckets of cash?
I suppose they did, because people are classically, fixated on predicting what has already happened to continue indefinitely. We saw that with the Japanese influx of capital in the late 80s, right, when it was coming in and buying up everything in North America, famously things like Pebble Beach Golf Course and all this at ludicrous valuations. And then, indeed, it also stopped when the bubbles burst at home. And we've seen, for example, the Shanghai Stock Index is down well over 20% year to date. So we definitely have stocks falling in China with its growth rate decelerating, and now the tariff talk going back and forth. And of course, Chinese households have much less savings relative to North Americans. So their savings rate is higher, significantly higher, but their income, the average income level, is so much lower that the cash buffer, so to speak, is not very great. And also they have done a lot of highly levered purchasing of very expensive real estate at home. So they've also got a downturn in the Chinese housing market at the same time as their stock market. So we go right back to this correlation factor that I'm speaking of, where people's business income was rising and wages were rising as asset prices were increasing, and people were levering up with that cycle. And then just as their income starts to slow, in China's case, their exports start to slow, and now the tariff stuff is going to slow it further. You've already got the stock market falling, so their balance sheet is taking a whack at the same time that their income is falling. This is really classically the worst planning. This is why I talk about this so much. If you're going to be resilient through business cycles, if you're going to survive and thrive, you need to really do it in the reverse of the masses, which is to say, during the boom time, you need to pay down the debt and build up the cash savings and steer clear of bubbling asset prices so that you have the strength and resilience, so that even if your income does take a hit, even if you do lose your job or your business does decline, as it typically does during economic downturns, that you still have a cushion, safety, not just credit availability, but literal savings and the flexibility and liquidity to buy things off people who are having to sell once that process starts to unfold. And when you do it that way, you're literally drown-proofing yourself against the worst effects and prospering and taking advantage of the cycle rather than being decimated by it.
Right now, what kind of advice are you giving clients with their portfolios?
Well, we are calibrated to do it in inverse of the masses. So our clients have been counseled and doing that precisely. So over the past few years, they've been paying. They don't have debt. They've built up savings. We've kept them out of the most bubbling, egregiously priced assets and stuck with the more liquid, capital security deposits and that sort of thing. And the whole point of that is so that we have the liquidity ability and psychological strength to buy when others start liquidating. And, this has been an extended cycle. There's no question. It's 113 months to the end of October. That's since the stock market bottomed in March of 2009 and the economic cycle turned back up finally in June of 2009. There's only been one other time in the late 90s when it went 120 months. So we're already in very, very rarefied air here of economic cycles, and yet people are confidently predicting that there's no sign of a downturn. Well, what I'm saying is the downturn has already begun. It's evident in many things that we're following it, everywhere you look. So you need to sort of factor the reality of those recurring phenomena, which are natural, normal, and needed to keep us from, basically having great unhealthy imbalances in the economy and in asset values. The mean reversion part is the restorative phase that puts things back into the realm of investment quality again. So it's a helpful part of the cycle, but if you don't prepare yourself for it, then you're one of the victims.
Is it true most Canadians don't have any kind of financial advisor to try to give them a heads up on something like this?
Well, I think people do, but unfortunately they are primarily serviced by the financial sales side. So the insurance companies, the banks, the mutual fund brokers, most advisors, they are either working on the sell side or they are working for an institution that sells products or underwrites products. And so their advice is continually tainted in their interest of the sales organization, which is to constantly tell people to buy things and never give them the advice that is actually specifically tailored to the individual's needs, which in most cases is, pay down your debt first before you even worry about trying to buy into things like the stock market, build up your cash savings, do things in inverse to the cycle rather than trying to follow the masses in and over the cliff and down. So yeah, people do have advisors, but there's a very, very small percentage that are getting, as I say, this very fiduciary orientated, just what's in the client's best interests and not a sales pitch about something.
Danielle, how can you find a person who gives you the right kind of advice?
Well, they're there. I mean, you can certainly email me through my blog site, Juggling Dynamite, and I very often will answer questions for people or direct them or try and give them some general overview, try and steer them in the right direction. So lots of people send me mail that way, and I'll do whatever I can to point them in the right direction.
Is that saying the secret to being wealthy isn't making money in good times, it's keeping your money in bad times?
Well, it's both. It's keeping your money, building it up in good times, but then having it to deploy in the bad times when valuations are the best of a decade and sometimes 2 decades. And I think the opportunity coming, because everything was increased and inflated with this extraordinary financial intervention of central banks over the last decade, because we see the correlation of everything that went up together, that same bucket of stuff is going to very likely price correct in the same time frame, which means it'd be like clearance sales left and right. And the question is who will be able and ready to take advantage of that.
Danielle, thank you so much for chatting with us.
Hey, thank you.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. If you have any questions for Danielle or any of our other guests, you can send them to info@howstreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of House Street Media Incorporated.